we're coming into the end of the week, an absolute crazy week in markets. Look, I've been in markets now almost 30 years, and I can't remember the last time that we saw moves, chaotic moves, chaos in the markets like what we've been seeing in this last week. Certainly very, very dangerous markets. So anyway, let's go through the markets and starting with equity markets. So equity markets obviously have been under a lot of pressure ever since Trump imposed reciprocal tariffs and shocked the world with just the size and the scope of those tariffs. On Wednesday, he did backtrack, did make a U-turn on those reciprocal tariffs, and we saw the second biggest rally in equity market history. The Nasdaq going up 12% in one day. Absolute phenomenal stuff. But look, that was short-lived. The very next day, we're back to selling again. So look, there's a couple of reasons for that. Nasdaq actually closed S&P Nasdaq down almost 4% overnight. At one stage, almost they were down 7%, and where the first circuit breakers kick in. So look, it was a very, very heavy day. The reasons for that, one is that reality did kick into the market. Even though Trump did wind back on reciprocal tariffs with a 90-day delay, he still does have a universal 10% blanket tariff for all countries and 125% for China. China and US at the moment, big concerns there about how that's going to all play out, because China certainly is digging its heels in and says it'll fight to the end. So look, the tariffs are changing global economies, changing global trade, and it is something that is not going away tomorrow, and yes, it is a negative for the market. So yes, reality did hit equity markets. That was part of the story. The other part of the story is that yesterday the US government has agreed to increase its budget deficit from 2 trillion to 3 trillion. Now that is a huge deal. What that basically means is that the US spending is still out of control. It means that obviously Trump and his government do intend to increase spending, and when they increase the deficit by as much as $1 trillion, it means that they're going to have to finance that by selling a lot of bonds. So when you get a flood of bonds entering the market, that basically makes yields spike up. So we're seeing US 30-year yields spiking up to 5%, and also US 10-year yields going up to 4.5%. This is very, very, very bad. Higher bond yields basically means that borrowing costs for both the government and also for corporates increases. Just to give you an idea, with the US government, just 10 basis points in US 10-year yields increases interest costs servicing debt by as much as $26 billion. Basically, higher yields, a big negative on the economy. Can contract the economy very, very quickly. So at the moment, the market is reacting also, equity markets, to what's happening into the bond market. So I would be watching, if you are trading equity markets at the moment, watching these bond yields very closely. If these bond yields continue to spike higher, we get 30 years above 5%, and God help us if we get US 10 years going anywhere near 5% or over 5%, there's no chance of an equity market rally. And the complete opposite, we may see equity markets get hit, and hit very, very hard. So again, if you're trading equities, you need to be watching these bond yields. Bond yields start going lower, that's going to be good for the market, but at the moment, it certainly does not seem the case. The other point, just with the equity markets when we finish up, is that, look, long or short, it's super hard to hold a position. I'd almost say it's impossible to hold a position. If you're trading equities, you are being forced to be a day trader, you've been forced to be a very short-term trader. So you need to adjust your trading style, to be happy to trade short-term and watching the market very closely. But look, equity market's absolute complete mess. Okay, so moving on, commodity markets. Look, one market that is not a mess, and it's probably one of the easier markets out there at the moment. It's not seeing that two-way volatility, and that is crude. Crude has been trending quite well, and it's trending south. It doesn't like two things. One is tariffs, because obviously, it decreases global trade, less demand for crude, and then also with economic growth globally being hit and potential recession talks coming, that's also a big negative for crude. So yes, we are seeing crude now down towards $60. Look, still think that targets down towards $50 before all of this is over are certainly realistic. So look, that's probably one of the safer markets to be part of, selling crude. Gold, look, that has not been an easy trade by any stretch. We did see gold, get hit by, over $200. A lot of traders who are losing in equity markets doing their pants there. We're selling gold to pay for some of the equity market losses. But look, the buyers have certainly stepped in the last couple of days when we traded below 3,000. So we one-way traffic again back up to record highs. So new record high overnight, record high close. So gold is back doing what it does best, and obviously very bullish again. Look, we're opening Asia at the moment, almost trading towards 3,200. That's obviously going to be a short-term target. Look, breaking that, look, that opens up 3,250, and I guess the gold bulls, even short-term, may even want to go for 3,300. So look, yes, again, it's probably not the time to sell gold with it back trading exceptionally bullish. Okay, so moving on to the currency space. There's been a lot of action in the currency space. Last night we did have some US data out overnight, which is very important. US CPI data for March, that actually came in lower than expected. So we saw headline inflation come down from 2.8% down to 2.4% from the previous month, so much lower than expected. And also so core go from 3.1 from the previous month down to 2.8, again lower than expected year on year. So we have a market that is definitely expecting a Fed to start cutting rates. The market wants at least 4 to 5 rate cuts from the Fed. So certainly that has helped sell the US dollar. So we're seeing a lot of US dollar selling across the board. Dollar index got hit over 2% overnight. That was one of the biggest hits the dollar index has seen for a few years, since 2022. Dollar index is trading down towards 100. Which has been a huge psychological level. The US dollar for the dollar index at 100. So if the dollar index does break 100, obviously we could see some momentum selling of the dollar index and the US dollar, and then obviously continue to trend down. But certainly market is in a mood to sell US dollars. One of the biggest moves was with the dollar Swiss. Dollar Swiss was actually down, almost around 3-4%, and down toward its biggest fall since 2011. A lot of safe haven flows still flowing into the Swiss. So big move there. So look, I'd suggest at the moment, going with this, and that I would not be fading this US dollar selling at the moment. Look, to end the week, we don't really have much on the economic data front. That doesn't mean that we're not going to end Friday with more volatility. We've got a VIX index that's above 40, which is certainly is not bullish. But certainly, I think really need to focus on position sizing. Wouldn't get too big with what's going on, and then maybe trading with a much shorter term bias. And then obviously we've got gap risk coming out for the weekend, so before the close it might be wise to pare down some position sizing there again, because no doubt, weekends at the moment we're getting a lot of headlines and a lot of gap opens on a Monday morning, so you need to be aware of that on the close. Good luck with your trading today, and we will check back in with you on Monday.